name is Paul Peck. I'm a Regional Vice President with Metro Public Adjustment, and I'm going to talk a little bit today about insurance, basic insurance information and terms. We are asked often to look at declaration pages for our clients and identify for them what they are covered for and what kind of coverage they have. It's incumbent on us to know a little bit more than they do about the insurance policy. So what I want to do today is go through some of the basic terms that are used in policies and make sure that we're very comfortable with that. The first thing that we need to know is that we have to find out what an insurance policy is. And an insurance policy is basically a contract between the insured and the insurer. The insured is our client or the prospect or the person that we typically are talking to. The insurer is the insurance company. This is a contract of adhesion. Now, what that means is that the client, our client, typically has not been able to modify or make any changes of significance to the contract itself. The contract is something that is placed on them. They have no say on redefining a term or on the wording of a clause or of a peril. They have to accept the contract the way it is. They can add additional language associated with new endorsements, new coverages, or eliminating coverages, but they can't change the way the coverages are stated, and that's called adhesion. That means that the client is drawn in and is forced into the policy. Why is that important? Why do I spend this much time on this? Well, any ambiguity in the contract, when it's a contract of adhesion, any ambiguity is favored to the insured, not to the insurer. So if there's a question as to really what the insurance company is stating in the policy, that question is typically put in favor of the client, not in the insurance company. The primary goal of a claim is to satisfy the insurer's obligations to the policyholder or the insured. So the claim is that vehicle by which the policyholder can get satisfaction from the insurance company. And it's their promise to cover, typically, any direct physical loss that is sustained because of a covered peril. This promise is fulfilled by providing fair, prompt, and equitable service to the policyholder. They are required to indemnify the policyholder. That means indemnify means not to increase the value of the policyholder, but to bring the policyholder back to pre-loss condition. And this is done through the claim, and it's a payment to the insured who's listed on the policy. That is the first party claim. The declarations page, which is the page that we spend all of our time on when we're discussing the policy with our clients, that declarations page is really a summary page of what the coverages are, what the loss values are that are listed on the policy. Sometimes it'll indicate the perils that are covered by the policy, and it will cover endorsements or additional coverages that might be involved in the policy. When we do policy reviews, we need to keep in mind a couple of things. First off, all insurance companies are not equal. They have significant differences. In fact, the language, the definitions of terms can be very different one company to another. So when you review your client's policy, your responsibility is to make suggestions that are going to make the policy more advantageous to the client. What does that mean? That means making sure that policy limits are correct, or at least are in the right ballpark. Making sure that if the client has a sump pump, that they have a sump pump endorsement. Making sure that personal property is identified correctly. Those are things that we can do on a policy review to ensure that the policyholder is most advantageously represented in that policy. We also have to understand that some of our suggestions may not be part of that policy, may not even be options on that policy. They may not even allow changes to the policy or particular endorsements that we think might be valuable to our client. In those cases, it's important that we always make those recommendations anyways, and then offer the client 3 or 4 other alternatives of companies that they might look at that might provide them the correct coverages that we have discussed with them. We never want to recommend just one company. Always have 3 or 4 companies that you know of that have good policies and that have good track records of paying their policy holders when they have a claim. So let's go over some of these additional terms that are part of the contract, part of the policy that we don't typically review in our classes. A first-party claim is a demand. I like that too. It is a demand by the policyholder or the insured to get coverage, to seek recovery, to get compensated for damage that they have sustained. Understand that they may cover. In other words, the insurance company always reserves the right to determine whether or not something is covered or not. The claimant are typically our policyholder. The claims representative is us. We are the person responsible for looking at the claim, looking at the damage, evaluating the damage, and oftentimes if we're getting involved with the field adjuster in settling the claims. An independent adjuster is someone who works for the insurance company but doesn't work directly for them. In other words, they may handle multiple insurance companies. A lot of the smaller insurance companies use independent adjusters because they don't have a density of claims in a particular area to justify a full-time adjuster on their payroll. A public adjuster, that's us. We are an outside organization that's hired by the policyholder to represent them in exchange for a fee. Reservation of rights letter. This is an interesting letter that the insurance company can sometimes place when settling a claim. What they will do is they will sometimes say, we're not sure that this is really covered. And we want to make sure that the policyholder understands that we may or may not cover this part of the claim. What they will do is they'll write a letter saying, we're accepting this claim, but we reserve the rights to deny coverage later should the facts warrant it. In other words, if it is shown that something was in fact wear and tear and that the insurance company really isn't responsible for compensation on that component or that piece of the claim, they're reserving the right not to pay. And you will see that sometimes on more complex claims. A non-waiver agreement is an assigned agreement by both the insurance company as well as the policyholder that they are not waiving their rights under the policy. In other words, they are holding to the policy. This is not untypical either. Subrogation. Subrogation is where the insurance company pays for a loss based on the fact that they have an agreement, they have a policy with the policyholder. However, there's another cause to the loss, or there's someone that they should recover their damages from. So let's say, for example, I had a client who had a PJ Richards, which is an appliance retailer. They installed a refrigerator, and they installed the water line to the refrigerator poorly, causing the water to drip out of that line, causing damage to the floor on the kitchen, and also resulting in damage to the ceiling in the basement of a finished basement, causing eventual collapse of that ceiling. The insurance company paid for that loss, but then what they're going to do is they're going to subrogate that loss to PC Richard. In other words, PC Richard screwed up, so they should pay for this loss. It is the responsibility of the insurance company. In other words, the homeowner shouldn't have to go to PC Richard and say, hey, fix my ceiling and fix my floor. They have an insurance policy to cover that. But the insurance company has a right against the PC Richard, the installer. And so that's subrogation. A direct loss, that's usually the damage. That we call it damage. It's the reduction in value of the property. So if a hardwood floor is gouged, that's a direct loss. In other words, that has damaged the value of that whole property because of that loss. Coinsurance is an interesting concept, and what that basically states is that it's the insured responsibility, the policyholder's responsibility to have coverage on their property equal to a certain percentage of the value of that property, no less than that percentage. The percentage is typically 80%. But when we're going through a property, we should be able to identify what an average construction cost is per square foot. And although we are not appraisers, and you want to make sure that you always state that you are not an appraiser and you are not qualified to appraise, you can in fact talk about the fact that an average home, what the cost is per square foot for reconstruction or for construction. You can actually Google that typically in any particular state or metropolitan area. You can Google and ask what is the average construction cost and then state the city. And Google will actually come back with, there's a couple of websites that determine that and give you average numbers. The appraisal clause is an ability for the policyholder to seek additional compensation or resolve an issue should the insurance company not be forthcoming in providing compensation. In other words, the insurance company is holding back and is saying, nah, we're not going to pay, or we don't believe we have responsibility for this component of the loss. And the policyholder or the public adjuster feels that they should be paying that. The appraisal clause allows us to get a resolution to that without having to go to court. And it's oftentimes what it involves is having other adjusters come in and review the estimates and come up with a compromise or a resolution in one party's or the other's advantage. Actual cash value. When you're dealing with an HO3 policy, the actual cash value comes into play on personal property. When you're dealing with an HO5 policy, it automatically goes to replacement value or replacement cost. But actual cash value is the depreciated value of the property. So if you have a dining room set that has a 20-year life expectancy, if you will, and they've had it for 10 years, if they bought it for $1,000, it's now worth $500 because it's gone through half of its estimated life expectancy. So the insurance company is going to pay you $500 for that $1,000 item. If you have replacement cost, like an HO5 policy or an endorsement on an HO3 policy, then the insurance company pays the dollar amount needed to replace the structure or damaged property without any deduction for depreciation. But what it does do is it allows you to go to whatever the market value is of a current unit today and buy it for that amount. So if that same dining room set today costs $1,500 to buy, then even though you spent $1,000 for it, the insurance company will pay you $1,500 for replacement. Oftentimes on personal property, and sometimes on the buildings as well, on construction, the insurance company will pay actual cash value and then will request receipts in order to pay out the difference, the holdback. And that holdback would be the difference between the replacement value and the actual cash value. An endorsement is an addition to the policy. Now, that addition to the policy doesn't mean that it's necessarily been expanded. Sometimes it limits it, and sometimes the limitations are pretty important to know. But an endorsement is something that we always want to look for because endorsements modify the basic policy. So an endorsement could mean additional coverages like sump pump, like codes and ordinances, or replacement value on personal property. Or it could mean a limitation of benefits like, again, I'll use the sump pump because what the sump pump does is it limits any liability to a maximum of $5,000 or $10,000 or $15,000. So that you can't go to the limits of the policy for compensation. You are limited in compensation to whatever that dollar value is that's in the endorsement. Unearned premium. Oftentimes, a client will tell us that they are unsatisfied with their insurance company and are asking us for alternatives. The next question that they're going to ask is, well, what happens? Do I have to wait till the end of this policy period in order to go to a new insurance company? And the answer is no, they don't. The way insurance is billed, you pay it in advance. However, if you have an unused portion of that premium, in other words, I only go 2 months into a policy and then decide, I really don't like this insurance company, I'm going to go to another one. The former insurance company has to rebate me the remaining 10 months. So that's called unearned premium. And that is something that is recoverable when you do change insurance companies. So that is not a lost value if you do make changes. Proof of loss. This is a statement that is prepared by us typically that will define what the loss is on the property and what the compensation is. It is also, when it's done by the insurance company without a public adjuster involved, the signing of a proof of loss is often done with a notary. So it's a notarized signature. And it often will close the case. In other words, the insurance, the policyholder has no further remedy with the insurance company beyond what has been paid. And that proof of loss is a statement that says that the insured is now satisfied in full with what the insurance company has provided. Examination under oath, an EUO, is often done by an insurance company. Honestly, it's more punitive than almost anything else. It's a statement that's requested or required by the insurance company, by the insured, to the facts of a claim. And that examination under oath is done basically to scare a client. That's really the reason for it. You may have to prepare a client for this as a potential. But it is often done where the insurance company doesn't want to pay, doesn't have a good reason for not paying, and so is therefore trying to identify a way of making the problem go away. And a lot of people are very reticent about making statements under oath. And so that becomes a fear tactic. The next step beyond that is something called a deposition, which is actually a pre-trial discovery tool. If we are taking the insurance company to trial, there is no doubt that your client will be asked to provide a deposition. And this is a sworn statement, an oral testimony to the facts of the case. A lot of times the questions that are going to be asked are things that are very simple, but are going to be done in a number of different ways. The primary facts that are going to be requested is what date was the damage, what caused the damage, was there any other attributing force to the damage. They're going to try to get your client to say something which would allow them to deny the claim. And these are some of the more important terms that you should know regarding insurance policies. I hope this has been helpful. There's a lot more, but this gives you an idea of some of the major terms and some of the processes involved in the insurance, in an insurance claim. If you have any additional questions, feel free to contact me with the contact information that follows. And again, I hope this has been of good information for you. See you on the leaderboard.